You were not meant to be a slave to the grind. You were not meant to trade your life force for money. You can escape gravity. You can unlock your life. You got this. Let's go.
Hello and welcome to Unlock Your Life. It's Jennings here. Should you never sell a property? I hear this all the time. Buy real estate, never sell, hold it for cash flow. We always regret the stuff we sold. We look at it years later and wish that we had held on to that property. Do you ever feel this way? People talk, but what do people do? Because I've said this, hold for long-term appreciation, hold for the tax advantages, hold for the cash flow. And yet, here I am in a down market selling property. In fact, we just sold a property. We closed on it Friday. I'm going to give you a little quick breakdown of this. I'm going to tell you guys real stories about my real portfolio, where I am today. It's November 8th, 2023. If you're listening to this in the future, well, times are not great. The Fed is raising rates. They've raised rates 400 basis points over the last 2 years. They've paused. We don't know if they're going to continue to raise them. We don't know if they're going to maybe lower them or leave them flat. Are we on the brink of a recession? There's a whole lot of uncertainty in the market right now, but by all judgments, this is not a great time to be selling real estate. Real estate prices are a little bit down right now, and I just sold a property. So why did I sell a property in a down market? Why didn't I just hold it? Let's get into the story. So Goose Creek, I bought this back in 2019. I think it was like August, early fall 2019. This was a 63 unit. We bought it for $3.8 million and it needed a $1.2 million rehab. So if you can do the math, we were basically all in for $5 million. We had to raise $1.2 million for the down payment, and we did a 2-year bridge loan with Lima One Capital. Lima One gave us 2 years to do our thing, stabilize the property, raise the rents, do the rehab, get it fixed up, and then refinance it. So we did that. We were actually successful at doing that. We spent about 18 months turning over the rent roll, renovating the units, getting the rents to where they needed to be, kicking out the tenants that weren't paying, because this property was about 80% occupied when we bought it. Got it up to 95% occupancy, got it refinanced, and the bank gave us loan proceeds of right about $5 million. So we were actually, I think, 50 or 60,000 short of returning all of the investor capital. So investors put in 120,000, and at the refinance event, they got a check for 114,000. So there was $6,000 per investor left. And so that was great, right? And we had paid the preferred return currently along the whole way. So the investors were getting a 10% preferred return on that money while it was in the deal. Once it got returned, it stopped accruing because they had their money back. And so now we're refinanced and we've got all the investors out. We've got a pretty good debt on it. We got fixed 10-year Fannie Mae debt. There was no interest-only period, so we were amortizing right out the gate, but 30-year amortization. And I think the rate was like 3.75, like a pretty good rate on it, because this was, a few years ago. So we struggle along. We end up having to switch management companies. The management company that was managing it, we didn't feel was doing the best job, so we switched management companies. But every time we turned around, something was breaking. The air conditioners, leaks. The roofs were okay because we'd replaced them, but we had a parking lot that needed complete replacement. There was about 80% of it was broken down, and there really wasn't much cash flow. Being honest, right? You can say, well, Jennings, how is that possible? You did all this work, you stabilized it, but remember, we leveled up the debt, right? We took the debt from 3.8 million now to 5 million, and we've got escrows and taxes and insurance and et cetera, and it really just was not cash flowing as well. And any extra cash flow seemed to be eaten up by a lot of repairs and maintenance and just costs. And so the thing about this deal was it was worth significantly more than we paid for it. And we ended up selling it for $6.8 million, plus we got to keep any reserves, which was another 100 grand. So 6.9, for all intents and purposes, we sold the property for 6.9. And so there was about $2 million in equity tied up in this property, 1.9 million. But not really, because there's closing costs. We still had to pay back the investors their $50,000, $60,000 that was owed. We had done some capital injections that we had to recoup, and there was cost there. So you don't quite net that amount, but you do net a good chunk of money. And so when I was looking at this deal, I was thinking, should I sell it? I'm going to be holding it for years to come. I'm probably going to have to make more capital injections. I'm probably going to have to pay for a new parking lot. More air conditioners are going to break. This thing was built in 1968 or 1970. It was pretty old property. There was some delinquency. We'd gotten that under control, but it just seemed like every time we turned around, we were having to evict another tenant, bring somebody else in. And it was just not a super fun property to own and manage. It wasn't like easy. It was every week when we met about this property, it's kind of like holding our breath. Like, are we going to have to do another capital injection? What else went wrong? How are the collections? And so that being said, it was on my mind that, hey, maybe I should take the money out of this deal and redeploy it. And so I did kind of a calculation on return on equity. So if you look at a property that you own, let's say you're all in it for $2 million and it's worth $3 million. You can maybe sell it for $3 million. And let's say you could net $1 million. Well, if you're making $50,000 a year in passive cash flow, like free cash flow, this is after you've paid all your expenses, after you've paid your mortgage, after you've paid your taxes, after you've paid your insurance. What's the free cash flow? So if it's 50 grand, you're making about 5% in cash flow or return on tying up that $1 million in equity. Now, if you're amortizing debt, you could argue that you're making a little bit more, but that's not really free cash flow. That's locked up in your loan and you can't really access it until you refinance or sell. And so if you do this thing, what I've kind of looked at is if I'm making a 10% return on my money, like return on equity, right? So if I take my equity that's tied up, so for this example, if it was $1 million and I'm making $100,000 in free cash flow, then that would be a 10% return on equity in this scenario. This kind of incentivizes me to hang on to the property, right? Because it's cash flowing 100 grand a year. Yes, I could keep that. If I had to plop it back into the apartment complex to fix something, at least I'm not having to take cash out of my bank account. I can use the property to pay for itself. I may be amortizing debt. I'm also not incurring all the transaction fees of selling something, paying a broker, buying something, paying all the legal costs. I'm not going to recapture all that depreciation I took and get whacked on my taxes the next year. So there's definitely reasons to hold that. And if you're making a decent amount of cash flow, I would say 10% or greater, then it's something you should strongly consider. But if you're not making any cash flow or very little, 1, 2, 3% cash flow, and you can take and redeploy that money elsewhere, then it may be a better option. And here's the other side of that coin is when you buy something that's distressed and it has a problem, you can increase the value of that property significantly, right? We increased the value of that property from 5 million to 7 million or 6.9 million, right? That's a 40 something percent jump in value. Will I be able to make that property worth another 40% more in the next 2 to 3 years? Probably not. I'm already close to where the market top rents are. I can't push rents another couple $100 because the market just won't bear it. And so if I took that capital out, replaced it in something else that did have a problem that I could increase the value again, that might be a better use of my equity. Another reason would be maybe I just want more liquidity in the bank. So when we had that sale, we had a liquidity event, right? One, we got the money back that we had injected in the property. Secondly, we got our cut of the profit. Yade and myself owned a significant amount of equity in that deal, and so we got a decent chunk of change when we sold it. And then I look at the rest of my portfolio, and it gives me staying power, right? It gives me the ability to overcome future hurdles, right? What if I miss a refinance on another property or the refinance proceeds are a little short, I have to do a capital injection? What if we didn't escrow enough taxes for something and we have to make up the difference? Now I have a war chest of capital, and the larger you get, the more important that war chest becomes. So if you have a $60 million portfolio like we do, then that means we have quite a bit of debt, $30 million. Plus we have investor obligations of the money that they put in the deal. Like we want to return that capital to them. And so the more liquidity that we have, the safer the rest of my portfolio is. And so the point of this podcast is not to convince you to sell or not to convince you to hold. It's to convince you to think about this and don't think about these things as sacred cows. Don't think about these things as an emotional attachment where everything I buy, I have to hold on forever. Because why are you doing this? Right? Are you doing this for lifestyle? Are you doing this for freedom? Are you doing this for cash flow? Are you doing this for financial security? Are you doing this for fun? Because taking care of a property that is constantly eating money and is no fun to manage and is a problem that's sucking away your focus and time and energy away from the properties that are doing well, or maybe the next property you could buy that will do well, is not the answer, right? I'm doing this for lifestyle. I'm doing this for enjoyment. And if this property is not serving that purpose, I'm not going to hold it up as a sacred cow and say, I'm never going to sell anything. I'm never going to shed a property. I'm only going to hold forever and ever and ever. And someday when I'm 80 years old, I'll sell it for $100 million and it'll be just the best decision ever. Well, yeah, except you're 80. I don't want to wait till I'm 80 to enjoy my life. Plus, I want that security blanket of having that liquidity and having that staying power to shore up the rest of my portfolio or continue to do other deals if I see fit. So let's talk about individual deals that we are selling. I'm going to go through two more, and then I got one that we've sold, but I maybe am changing my mind on it. And why am I changing my mind? Okay, so we already talked about Goose Creek and my decision to sell there. Let's talk about Mill Run. Mill Run is in Statesboro, Georgia. It's an 84 unit that we bought about 2.5 years ago. And so we got a great deal on this. Our mortgage is $2.4 million, and I believe we raised about $1.2 million to do that. So all in, we're, I think 3.7-ish, 3.5-ish. And so we've got an offer on the table. We're negotiating the PSA for about 4.7. And so by the time that we pay everybody off and pay the preferred return and pay the investors back and pay the closing costs, we'll maybe net $800,000 or $900,000, which is, a solid deal. However, I know if I held that for another 2 to 3 years, I probably could get a much better price. I think the buyer is getting a pretty good deal on this property. $56,000 a unit. It's stabilized. It's full. Yes, it needs some more repairs, but it's not a problem. And it's actually cash flowing okay. But the reason that I'm doing this is because when we first closed that deal, we set the expectation with the investors that this was a 2-year hold. So in 2 years, they're expecting their money back. We've already been over 2 years, right? So we got caught in the lurch, switching management companies, the Fed raising rates. And with the Fed raising rates, refinance did not make sense. We had a great loan in place. It's for 5 years. There's really no reason to refinance that and get a 7.5% loan when we're at like a 4% loan right now. So I wasn't highly incentivized to refinance it, but the investors still want their capital back. And so in looking at this deal, it was kind of like, what expectation did you set? And when you start involving yourself with a lot of partners and a lot of opinions, and your investors are your partners, even though they're limited partners and they're not really involved in the day-to-day, their opinions matter. And you treating them correctly and doing the best you can do to fulfill the expectations that you set is going to incentivize them to invest with you again, And if you don't do well, it gets around fast. This is a very small world, and the investor bases talk to each other, and pretty soon you're not able to raise any more capital for any more deals because he doesn't do what he said he's going to do. And that's not a situation that I wanted myself to be in. So even though if I held this, I could make more money, and even though I did a lot of work and took on a lot of risk and took on a lot of debt, I'm not going to make as much of a profit as I would have liked to on this. That's the decision that's driving this deal. It doesn't have assumable loan, so the new buyer has to get a new high interest loan. And so that's driving the cost down, or the price tag down for him. So the reason, though, that I'm selling that one is because I want to get that money back in the investor's pocket. I want to get them the returns, and I want to live to fight another day. Let's go find another deal and move on. Haynesville, right? This is a 73 unit that we have in Monk's Corner. We bought this thing for $2.5 million, but the seller agreed to loan us $1 million at closing. So they did not get $2.5 million at closing. They got $1.5 million with $1 million deferred. And we've been making monthly payments to them. And the reason we structured it that way is because the property needed another $1.5 million in rehab. And so we were able to be all in for this deal for about $4 million, but we had to refinance the $1 million out within, a few years. And so we owe this lady $1 million. Yes, we've been making her monthly payments, but there's a balloon and she needs to get her million back. And she's willing to work with us on the timeline, but we want to make sure that we're fulfilling our promise to her because we were able to buy this deal with no money down, with no investors. And even though it's not the ideal time to sell it, same thing, we've done a lot of value add to this deal. It needed $1.5 million renovation. It was half empty, tons of delinquency. We've taken the rent roll and increased it by like triple. So, I mean, we've done a huge value add on it. It's worth a lot more than it was. However, I know that, if I held on to it for another year or two, I probably could get a much, much better price for it. But I'm looking at the lady who loaned me the $1 million and I want to get her million back, and refinancing it, I just don't know that I would be able to do that. And then my mortgage payment would jump up. And then now I've got a non-cash flowing asset on my hands that I'm having to feed every month. Instead of get cash flow, I've got to feed it every month. And so this is something that I'm taking into consideration. And so even if I don't get the best price ever, I can still sell it. I can pay off my debt. I can pay her back. And I can make it still a pretty good profit because of how distressed that property was. Okay, so a lot of this is tying back into expectations. And this is one of the reasons as you advance in multifamily and as you become hopefully wealthier and more successful, you can have less partners, less opinions. And if you can do what's best for you without having to worry about what's best for them, because all things being equal, if we didn't have to refinance out this lady, I'd probably keep Haynesville. I'd probably keep it for a few more years and see where the market goes. However, I have a partner and she's expecting $1 million. So I've got to do something about that problem. Let's talk about the one where I'm flip-flopping. It's not so easy. It's not so cut and dry. So Tulsa, Oklahoma is 208 units. And we bought this very distressed, half empty. You've probably heard this story if you've listened to my podcast for a while. We were successful with the plan, right? We raised $2.4 million and we bought it for $5.5 million. So we're all in for about $8 million. And big rehab, got it stabilized. We took it to a bank back in 2020, got it refinanced. We got 4.25% interest or 4.125% interest on a 10-year fixed Fannie Mae loan, 5 years of interest only, phenomenal loan. And it appraised for, I think, $12.5 million. So they gave us loan proceeds. Of that, we were able to pay everybody off, pay all the investors back. Now we don't owe anybody any money other than the bank. And we decided to sell that. Well, why? Well, we went back to the return on equity kind of example there. We figured we had about $3 million tied up in equity. We got our insurance rates raised on us. The cash flow on the property is probably now dropping to about $15,000 a month. So that's $160,000, $170,000 a year in free cash flow. But there's still bigger repairs coming on. There's still air conditioners breaking. We put in $400,000 to replace the roof. We paid that out of refinance proceeds, but it still hurt to use that cash to do that. And so we're looking at $160,000, $170,000, but you're tying up $3 million. So that's really only like a 5.5% return on equity. And so this is what led us to think, hey, maybe we could sell this. And a broker told us, hey, you guys can probably get $14 million for that. $14 million, wow. That's a lot of equity. Now our return on equity even smaller. Well, sometimes brokers don't always tell you, well, I don't know. They do their best they can, but a lot of times what they tell you they can sell it for and what it actually sells for can be quite different. So we put it on the market and come to find out we're getting very few offers, 12, 12 and a half. We got one guy up to 12.8, but I don't know that he really was that serious about it because he kind of stopped communicating on the negotiation. So long story short, it looks like 12.8 is probably the max this thing would sell for. And now we have a decision to make. Do we want to do that? Do we want to pay all the fees and all the costs associated with doing that, have the buyer assume our loan and go forward, get our check and move on? And this is one where I'm talking to my partners now and saying, hey, look, we've refinanced all the investors out. Nobody's complaining to us. Nobody's mad that they don't have their money. The property is cash flowing. It is spitting off small distributions. We've got a great manager in place. We've done a ton of rehab. It is in pretty good condition. Let's maybe hang on to this for 2 or 3 years and see what happens to the market. Maybe we hang on to this for 5 years, 7 years, 8 years. I don't know. But this is not the best time to sell. We don't have to sell. Nothing or nobody is pressuring us to sell. So maybe let's just revisit that. If somebody throws out 14 million, maybe we'll sell it, but we don't have to. And we're going to continue to reap the benefits of the depreciation, the tax savings, et cetera, et cetera. The equity's already deployed. We don't have to go out and find another deal. And so this is one where I'm kind of flip-flopping, where it's like, yes, if we get a great offer, we may consider that, but I'm not going to fire sale this thing. I'm not going to sell it at a price that I'm not like, wow, that is a phenomenal deal. And I think that if I wait 2 or 3 years, I could, what goes down must come up. And I think the sentiment of the market will come back. Hey, I could be wrong, right? We could be on the brink of a huge recession, and 12.8 is the most it's going to be worth for the next decade. And then I screwed up. But do I take that gamble? And that's why there's no perfect answer. And every situation dictates a different approach. And that's why the point of this podcast is make sure you're running the numbers on your portfolio and looking at what is it realistically going to sell for? What are going to be my closing costs? What are going to be my tax ramifications? How much cash am I actually going to net? Is it worth it to redeploy that somewhere else? Or am I better just hanging on and waiting and reaping the benefits, paying the debt down and staying put? So I just wanted to bring that message to you. Don't let these properties become sacred cows to you. When I first was going into multifamily, I sold off 2 rental homes. I got great prices for them, and I was happy to sell them. I don't regret selling them. I still don't regret selling them, even though they're worth probably more than what I sold them for. But they gave me cash in the bank. They gave me a runway to transition full-time into multifamily. And so that was a good decision, right? I've got a self-storage facility with my sister, Crystal. It's running phenomenally. It's no problem. It's cash flowing. It's paying off its debt. We don't have any investors. We don't owe anybody any money other than the bank. We've got long-term fixed debt on it. So let's just keep it. Let's hang on to that. Same thing with a property I've got in Ohio. It's cash flowing. It's doing great. Let's just hang on to it. Keep it. Let it cash flow. Let's keep building the portfolio, because I know that long-term, yes, 10, 15, 20 years from now, those properties should be worth far more than they are today, just by the nature of inflation. And so if you can hold them, if they're easy to hold and you have good managers in place and they're not falling apart and held together with bubble gum and duct tape, hang on to them. If they're a pain, or you have constrictions on you and you have debt maturing, or you have investors breathing down your neck, then sell them. But those are not positions you want to be in, right? And I've learned from my mistakes with that, setting the expectations with investors up front. Instead of saying, hey, we're going to do a 2-year flip, I don't know what the market's going to look like in 2 years. Whereas if I set that expectation for 5 years, if in 2 years or 3 years it looks good to sell, then let's sell and nobody's going to be mad. But if I got to go the full 5 years, hey, that's the expectation that I set with the investor. And so longevity and timeline, the longer you have in real estate, the more forgiving it will be. Because over time, real estate does pretty much always go up, right? And I know there's going to be people that argue with me about that statement. But if you look at I'm talking 15, 20, 30 years, it goes up in value. And so hanging on to properties is a great idea if it's suiting your lifestyle and if it's not a capital injection nightmare and it's not a investors breathing down your neck nightmare, and you don't have other situations like that. So this is my word for the day. Never sell is not a great idea, because that may not be the best use of capital. Should you take it out? Should you redeploy it? Could you redeploy it? But make sure you're counting all the costs, right? Transaction costs of selling, tax implications of selling, transaction costs of getting into a new deal, risk of getting into a new deal, and effort. So all these things got to be taken into effect, but you need to be looking at these things probably on a quarterly basis. All right, guys, that's what I got for you today. Appreciate you tuning in, listening to some behind the scenes of how we're actually dealing with these issues and challenges and good things in the portfolio. All right, guys, have a great week and unlock your life. Peace.
This is thepodcastfactory.com.